Have you ever felt like accounting is some secret language that only experts can understand? Yeah, you are definitely not alone. But what if I told you it's actually as logical and maybe even as simple as making a movie? By the time we're done here, you won't just know the rules, you'll actually see the story behind the numbers. So, this is our big idea, the one thing to keep in mind. Accounting is just like producing a movie. We're going to use this analogy to make sense of everything, from recording the daily scenes to releasing the final film. Seriously, it's the key that's going to unlock this whole thing for you. All right, here's our game plan. We'll kick things off with our movie analogy, then we'll get into the core principles, the 3 golden rules, and then we'll actually put it all to the test with some real examples before wrapping up with a handy toolkit you can take with you. Okay, first things first, let's look at the big picture. Just like a movie has a clear production timeline, from shooting all the way to the big premiere, accounting follows this really logical 4-step process. It all starts with recording. Think of this as shooting the scenes for our movie. Every single financial transaction is a scene, and we capture it in a book called the journal. Next up is classifying. This is basically the editing room, where we sort all those scenes into chapters inside something called the ledger. Then we summarize. This is like creating the movie trailer, the final reports that give everyone the highlights. And finally, we interpret. This is the film review, where we step back and ask, so, what does this all actually mean? Now let's get to what is, and I'm not kidding, the single most important concept in all of accounting. If the whole process is our movie, then this right here is the law of gravity that holds that entire universe together. It's got a fancy official name, the double entry principle, but honestly, just think of it as a seesaw. For every single thing that happens, there's a giving side and a receiving side. And here's the absolute crucial part. They must always be equal. That seesaw has to stay perfectly balanced. Okay, so let's give these two sides their proper names. The left side, the receiving side, is called debit, and the right side, the giving side, is called credit. So a really easy way to remember it is this. Debit is what you get, and credit is what you give. Simple as that. So to actually use our seesaw, we kind of need to know what we're balancing, right? Well, here's the amazing part. Every single business transaction in the world, no matter how complicated it seems, can be sorted into one of just 3 simple categories. First up, you have personal accounts. This is for all the people and all the companies you do business with. Second, you've got real accounts. This is for all the real things the business owns, like cash or computers or furniture. And third, we have nominal accounts. These are just the names we give to the ways money flows, things like salary or rent or income from sales. All right, you ready? This is it. This is the secret formula. If you can learn these next 3 super simple rules, one for each of those account types we just talked about, you will literally be able to analyze any transaction that comes your way. This is the engine that drives the whole system. Rule number 1 is for personal accounts, so all the people and companies. The rule is simply debit the receiver and credit the giver. So if you pay one of your suppliers, they receive the cash, so you debit their account. It's really that straightforward. Rule number 2 is for real accounts, all our tangible stuff. The rule here is debit what comes in and credit what goes out. So when your business buys a new desk, that desk comes in, so you debit the furniture account. And when you pay for it with cash, that cash goes out, so you credit your cash account. And our final golden rule for nominal accounts, all those money flows, is debit all expenses and losses, and credit all incomes and gains. So paying rent is an expense, which means you debit the rent account. And making a sale brings in income, so you credit the sales account. And hey, here's a pretty cool little memory trick to help lock all of this in. Just think about the abbreviations. For personal accounts, DR can stand for debit the receiver and CR for credit the giver. For real accounts, think of DR as what comes in and CR as what goes out. It's just a neat little way to remember the rules when you're on the fly. Okay, that is enough theory, right? Let's get our hands dirty and see how these rules actually work in the real world. This is where everything is going to start to click. So let's start with a really common one. Imagine you're starting a new business and you put 50,000 rupees of your own cash into it to get things rolling. All right, take a second, just think it through. What are the 2 accounts that are involved here, and which of our 3 golden rules are going to come into play? Okay, let's break it down. First, the business is getting cash. Cash is a real account, and our rule is debit what comes in, so we debit the cash account. Now, for the other side of the seesaw. The owner is the one giving the money. Now, in accounting, the owner and the business are seen as separate entities. The owner's investment is called capital, and we treat that as a personal account. And what's the rule for that? Credit the giver. See, the seesaw is perfectly balanced. Awesome. Let's try one more. This time, the business pays 1,000 rupees in rent, and it pays with cash. So, same deal. Give it a shot. What are the two accounts? What types are they? And which rule are you going to apply to each side of this transaction? All right, here's the answer. First, rent is an expense. That makes it a nominal account, and the rule is debit all expenses. Easy enough. Second, you paid with cash. Cash is a real account, and since it's leaving the business, the rule is credit what goes out. So we debit rent and we credit cash. Perfectly balanced once again. We have covered a ton of ground. So to wrap this all up, let's put everything we've learned together into one final toolkit. Think of this as your go-to cheat sheet for understanding how accounting really works. This flowchart right here, this is the entire game. The path is the exact same every single time. A transaction happens, you identify the two accounts it affects, you classify them as either personal, real, or nominal, then you apply the correct golden rule to figure out your debit and credit, and finally, you record it. That's the entire system, from start to finish. You know, when you really boil it all down, it comes back to these three core ideas. If you can remember these, you understand the heart of accounting. Every transaction has two sides. The seesaw always balances. The debit always equals the credit. And those three golden rules, well, they're the key to unlocking any financial story you come across. So I want to leave you with this final thought. Accounting isn't just for big businesses. It's the language of money itself. And now that you understand the basic grammar, you can start to apply it anywhere. So take a look at your own world. What financial story are your income, your expenses, and your assets trying to tell you?